Today, we are talking about the one thing that has officially made every Indian household budget tighter this month. The rupee just crossed rupees 90 to the dollar for the first time ever. The market calls it a psychological barrier. I call it a salary cut that you didn't see coming. So what does rupees 90 per dollar actually cost you? Let's break down the real purchasing power pinch like adults. First, what does rupee falling even mean? It's dead simple. Imagine an iPhone costs $999 in the US. The price is unchanged. In January this year, you paid roughly 83,000 rupees for it. Today, you pay 90,000 rupees. Same phone, same Apple, but your rupee buys 8% less dollar than it did 11 months ago. That, my friends, is the falling rupee. So why is it happening in 2025? Three big reasons, and I'll keep it to three because more than that and we will start lying to ourselves. Reason number one, Donald Trump slapped 50% tariff on a bunch of Indian exports. Our single largest market suddenly got expensive for American buyers. The result? Fewer dollars flowing into India. Simple supply demand for dollars. Two, the foreign investors pulled out roughly 1.48 lakh crores from Indian stocks this year. They are scared of global slowdown, high US interest rates, and honestly, our market was getting pricey. When they sell Indian stocks and take dollars home, rupee takes a beating. And the third important reason, we import almost everything that burns, shines, or beeps. 85% of our crude oil, most of our gold, electronics, defense equipment. When the global prices are high and exports are down, we keep bleeding dollars. The October trade deficit hit a record $41 billion. That, to be perfectly clear, is not a rounding error. Now, let's be precise. What is happening right now is called depreciation. This happens gradually in the open market. It's the simple result of supply and demand for the dollar. If RBI deliberately decided to whack the rupee lower overnight, say to massively boost exports, that would be called devaluation. The last big one was in 1991. And here is where the RBI comes in. Their role has quietly shifted this year, and it's worth noting because it's amplifying this slide. In the past, like during 2013 taper tantrum, the RBI would burn through forex reserves to aggressively defend specific levels, say holding the line at rupees 80 or whatever. Not anymore. They have moved on to a more flexible stance, focusing on smoothing out wild volatility rather than rigid interventions to prop up the rupee at all costs. Why? To preserve those reserves for real emergencies. And honestly, because letting it depreciate a bit can help exports in theory. It's like the RBI is finally saying, we are no longer the rupee's bodyguard, just the referee keeping things from getting too chaotic. A pragmatic change, but it means that rupee is finding its own floor right now. Now the part everyone argues about. Is this good or bad? In fact, it is both, and it's not a cop-out. The good side, if there is one. Anything we export, software, pharma, textiles, spices, just got 7 to 8% cheaper for the rest of the world. In theory, we should sell more. In reality, tariffs killed that party for now, but the price advantage is still there. The bad side. However, it is bigger for most of us and it hits directly. Everything we import just got 7 to 8% more expensive. Crude oil, higher petrol, diesel, and LPG prices, edible oils, fertilizers, electronics, your kids' foreign university fees, all is up. And because India is an assembly economy, where we import components from China, assemble them here, and then sell them as Make in India, company margins are going to get squeezed too. Quietly, inflation is going to creep up. The RBI might cut rates this week, but don't celebrate it. They are cutting because growth is slowing, not because they really love you. But mostly, they may inject liquidity into the system. We will know for sure in a couple of hours. So what's next? Realistic range by March 2026 is 92 to 94 rupees if nothing dramatic changes. 88 to 89 rupees if the US and India finally sign a mini trade deal and FPIs come back. Long-term fix? Same boring stuff economists have been saying for 20 years. Export more sophisticated things, import less crude and gold, bring in stable FDI instead of hot money that runs away when Jay Powell sneezes. Until then, the rupee will remain the most honest report card of our economic management. Right now, it's a flashing amber. not red, but definitely not green. So no, the economy is not collapsing. And no, the government didn't secretly want 90 rupees per dollar. They just decided defending every single paisa costs too many forex reserves. The decision was pragmatic, not sinister. That's it. Calm, slightly painful, but entirely fixable if we decide to fix the structured stuff instead of pretending PLI schemes and Atmanirbhar slogans magically print dollars. If you found this useful, share it with one person who still thinks forex rates are decided by mood swings in North Block. And if you want more no fluff real world breakdown like this, hit subscribe. I'll see you in the next one. Take care. Thank you for tuning in.